All right, I think we're going to go ahead and get started. Welcome, everybody. My name is Jason Hamilton. It's been, sorry, I took a month off. July was kind of hectic and crazy, and we didn't have a WebEx. But happy to be back with you here in August and kind of catch up on what's happened this summer, what's really happened for the year. We have one of our investment advisors today that'll be speaking, and he's deeply entrenched in our day-to-day of what we do as an investment firm for our clients, stock picking, mutual fund selection, fixed income. He kind of does it all. But Greg Watkins has been a part of our team for quite a while. Wanted to change up a little bit today. He's going to speak to overall kind of market commentary, give an update, kind of where we've been, where we were, and just talk about, how quickly, the market declined on us, but how quickly it's rebounded, and amazingly where we are today. I think, for those of us if you've been joining this WebEx series from the beginning, which goes back to April, April was a pretty scary time. No one really had answers. We didn't know what was coming. Didn't know what to expect of the market. We just had to put our faith in our investment discipline and our processes and hope that we would recover with the market and hit a little bit softer than what the market was back in March. And now here we are today. Greg, as I said, he's also part of the interest rate committee. So, we've spoken in the past a little bit about market commentary, what's happening. But Greg's also going to give a different side beyond the market commentary and things, and that's going to talk about fixed income. We haven't covered that at all through this WebEx series, and I think it'll be nice to hear a little bit about interest rates as they've kind of bottomed out also and have made a slight tick up. What does that do for your investment portfolio? How does that change your investment process maybe, or your discipline, especially if you're someone that's seeking yield? Where does that drive us as investors with bond rates and yields being so tremendously low? So with that, I appreciate Greg hopping on here. He's a newbie, so he's not done this with us, although he's doing many other things. He's just not participated in his WebEx series with us, so we're happy to have him. I will say we'll leave questions for the end of the presentation. And if you came in on your computer, you can chat that question. There's a bottom center of your screen on that menu. There's looks like someone blowing a bubble gum, a bubble. You can chat a question to me, or you can *6 and take yourself off mute, and you'll be able to ask questions that way. So without further ado, Greg, I'm going to kick it over to you. Thanks for joining us.
All right. Thank you, Jason. Please excuse me. I'm a little hoarse from this weekend. I attended an event this weekend, and I did a lot of screaming and whatnot. But nevertheless, good morning. I'm Greg Watkins. Jason said I'm an investment advisor here at Stockyards. I'm going to talk about three main things today. I'm going to talk about the underlying economic data. I'm going to try not to put everyone to sleep and get too deep into the numbers. I'm also going to talk a little bit about the fixed income investing environment, as well as some uncertainties. Touch on some uncertainties that we see going forward. So kind of to start off with economic data, one of the main things that we look at, and I think a lot of people pay attention to on a monthly basis, and to the all the way to the most astute to the just general marginal investor, we get the government's assessment of the labor market every month, and there are several key statistics associated with that, most notably the change in non-farm payrolls, as well as the unemployment rate and the labor force participation rate. The one that you hear on the news at night is generally the change in non-farm payrolls. And this past year, we've seen historic swings in those individuals being added to the payrolls or laid off. From the historic peak we saw a monthly decline in the month of April of over 20.8 million individuals, followed by May's record rise of over 2.7 million, each one of those in a single month. And the numbers have just absolutely been eye-popping. To put those numbers into perspective, the next largest drop ever followed the end of the war effort in September of 1945 with a monthly drop of 1.9 million. So in the month of April, we eclipsed that by a factor of over 10. So just to put that in perspective of how severe this downturn was and how quickly it came. And then by the time we get to the monthly data, it's generally already a several weeks stale. So when the monthly data comes out, it's usually taken in the middle of the previous month, and then they report it at the end of the month. It's generally a little stale. So there's another data set that we follow, and it's a weekly data set, and it's usually about a week lag, but it's at least we get that data every week, and it's the initial weekly claims and the continuing claims. What this shows are individuals filing for unemployment benefits for the first time, as well as individuals who continue to claim benefits each week. So last week, we saw this where we still had about 14.8 million people were continuing to file unemployment claims. That is down from an April peak of about 25 million individuals in a single week who were claiming unemployment benefits. However, we do still see on a weekly basis about 1 million individuals file for claims for the first time each week. And so that's what we got last week, and the expectation for this week is about the same. So it continues to be a troubling data set for the market as a whole. So, what we look at is has the employment or has the labor market changed forever? Will many of these jobs never come back? You can think of what Amazon has done to our economy for the good or for the better or worse. Where you don't have to leave your home to pretty much buy anything. They've also forced other retailers into the same space, most notably Walmart being the second largest online retailer. And so they've changed the market as a whole, and whether or not this sticks forever, who knows? I can recall back to my early years of my investing career when the dot-coms first came out, and most notably, some individuals may remember the name eToys, and where you could buy toys online. The theory was you could buy the same toy at a much cheaper price, but the problem was the individuals buying the toys, children, they want to touch the toy. They want to take it home today. They don't want to wait for it to show up in the mail in a couple of days. And so that, Amazon kind of changed the market as a whole, and whether or not this is a titanic shift in the way we do business in the retail sector, who knows? We also saw this year a record number so far, with a record number of bankruptcies with over 180 and counting, mostly in the retail and energy sectors. Many very notable retailers have filed for bankruptcy. That doesn't mean they're going away. It means they're reorganizing their debt, but some of them have filed for liquidation. And, other service-oriented areas of the market, most notably gyms and exercising type of facilities that obviously require them to be open for them to, you can't do that online. I guess you can through some of the other, through Peloton and some of those other ones, but lifting weights, and if you don't own them, you have to go someplace else. So switching gears from the economic data front, I want to take a look, peer into the fixed income side and what we saw earlier this year. What we saw was at the beginning of the year, we saw the U.S. 10-year Treasury peak on 12/31 of last year at about 1.91%. It has declined where it's trading today at around 0.71%. At one point during the height of the madness in March, that 10-year rate was below 0.4%. So just think of what that means. You're buying a security where you're guaranteed to only earn 0.4% over the next 10 years. So this reflected the fear that we saw in the markets at that point in time. And if you recall back to the first quarter of the year, it was a negative quarter for many diversified investment managers because only one sector of the market showed positive returns, and that was in Treasury. So if you owned any agency securities or corporate bonds or municipal bonds, those bonds, investors flew out of those in what we call a flight to quality, sold out of anything with any sort of credit risk, and moved to the highest level of quality of bonds in the month of March, and that would have been Treasuries. Treasuries were significantly overvalued, and we think to some degree appear to be a little bit overvalued. But what we saw some astute investment managers do during that downturn was take advantage of that mispricing and of some high quality names and purchase some of those names at very depressed prices, and then see those returns recovered in the second quarter of this year through where those bonds recovered from those panic levels. And so we don't do a lot of trading in our fixed income. We like to buy and hold. However, we do employ managers that have a greater expertise in that trading. But if you like a laddered portfolio, if you like to buy and hold, and as the maturities roll off, you just reinvest to the back of the ladder, then we want to hold some very high quality securities. On the inflation front, the inflation is currently well below the Fed's 2% target. I think the last reading was around 0.9%, and I think going forward, it's anticipated to be in the 1 to 1.5%. So which is still well below the Fed's target of around 2. And the Fed has signaled that they are going to be very accommodative until they see inflation tick above that level. And they've even stated on numerous occasions, and a quote, "We aren't even thinking about raising interest rates." So they're signaling to the market, it's not something that we think that's going to happen in the foreseeable future. And my guess is that they will be very, very transparent in what they intend to do. And when that time comes that they feel they need to raise rates, we will probably have about a 6-month lead time for them to signal, and then signal stronger and signal stronger. But my sense is they want inflation to run a little bit hotter, a little bit above 2% for some period of time before they start to raise interest rates to kind of slow growth down a little bit. The problem they ran into a couple of years ago was right as inflation was hitting 2%, and there were things that pointed to inflation heating up. They raised rates one last time, and many thought that was the point at which the economy was on its leg down. So, they're pointing to rates being lower for longer. They've signaled that, and they've signaled that they're okay with the inflation running above their target for the foreseeable future. So what does this mean for your fixed income portfolio? So as I indicated, we're certainly not reaching for yield by lowering credit quality. We're not buying lower quality bonds to give you a higher rate of return in your bonds. But we do believe the bond portion of your account should be dedicated to controlling risk for the most part. And if that's the case for you as a client, and if that's what you're looking for as well, then you should probably be in more of the higher quality or intermediate term bonds. And if you do want to start reaching for yield, then you really should start to classify that asset class as being more of a risk-taking type of assets. For instance, if we were to invest in high yield bonds, which are bonds that are below investment grade, many would call those junk bonds. A lot of portfolios or diversified portfolios will have a small sliver of that, and they're okay as long as you have a manager that is keeping up with the tabs on those bonds. But you certainly don't want a substantial portion of your portfolio dedicated to that, and that being your only source of an anchor. But we would classify that as being more of an asset that isn't a risk control asset. We would classify that as something that is, you're taking on additional principal risk in that you may not get all of your principal back at maturity. The other thing that we're looking at is on the fixed income side in the municipal market. You're seeing municipal bonds having yields that are very much below yields that we're seeing in the credit markets. Pardon me for just. Pardon me. You're seeing yields in the municipal markets that are substantially below that of the credit markets, and what we would say to that is that could be a signal for where the political polls are currently pointing to, in that maybe we're going to see interest rates, or not interest rates, the tax rates rise at some point in the near future, or within the next 12 to 18 months. If we see a change of regime within the White House, or even if we don't, there is a chance that to fund all this debt that we've taken on, that interest rates, the tax rates will rise, and that makes municipal bonds more valuable. And as investors position themselves for the potential for that to occur, you're seeing investors pile into these municipal bonds, and they're extremely hard to find, and they're an extremely pricey securities. And you're also seeing the coupons on some of these below 1%. So you're seeing a decimal point on the beginning of the yield on some of these bonds. So unfortunately, as I just spoke to on the taxable side, we don't reach for risk on municipal bonds either. And unfortunately, the yield environment is what it is. And if you truly are investing to control risk, then you got to stay in the high quality space. And so that's kind of where we land on that perspective. The last thing I want to touch on before we get into some questions and take some questions from people on the phone are some of the uncertainties we see forward. The three that I wrote down today are, the continued economic recovery, presidential election, and geopolitical tensions. The continued economic recovery, if you really dig deeper into the economy, we're still seeing troubling unemployment numbers and troubling numbers of individuals who are without a job. And so we think, or much of the financial press that I read are pricing in a high probability that we're going to get a second stimulus plan for individuals who were laid off. The PPP loans that were put out are some of those loans are coming up on 8 weeks, and I think the terms of the deal indicated that if you held on to these and you keep these individuals employed for 8 weeks, then the loan would be forgiven. And so I think one of the things that that we're looking at that is uncertain is the number of firms that choose to go ahead and lay individuals off after they've been forgiven the loan. And so they basically prop the economy up for a couple of months, and then you have the opportunity to take that money from the government and get the forgiven on the loan, and then you can lay off the employees. And you can debate whether that's the right thing or the wrong thing to do, but we still have to be mindful of businesses or they have to they have to manage their balance sheet. And I think maybe this was a very good way for the government to be able to put money in the hands of individuals on somewhat of a selective path. But we certainly need another type of stimulus bill, and we think that there's a high probability that occurs. Both political parties can't stand the political backlash that they would receive if they continue to banter back and forth and not get some sort of stimulus deal sometime in the near future. Which brings me to the presidential election. I have taken numerous questions and phone calls from clients indicating if we continue to have the same regime, that things aren't going to be good. If there's a change in the House, things aren't going to be good. Change in the White House, things aren't going to be good. If you go back and look in time on what a presidential election means to the stock market, the biggest thing that you want to look at is the removal of uncertainty. So if you're a business owner today, I use this example a lot. If you're a business owner today trying to plan for a capital investment in July of 2021, and so this time next year, or August of 2021, and you're trying to determine what type of economic environment you're going to be under or tax regime that you're going to be under, there's a high degree of uncertainty as to what that's going to be based on what this next election outcome is, and whether the outcome is what you want or what you don't want. The one thing that will be removed is the uncertainty, and whether it's an outcome you don't want, but you can at least plan for it for the next 4 years. So you can plan for what you have to deal with. And right now, many individuals can't reliably plan for what they think is going to occur within the political environment over the next 4 years. And then the last thing are geopolitical tensions. I'd say geopolitical tensions, I think we're probably coming up on a peak of, not a peak, but I think geopolitical tensions continue to escalate around the world. Isolationism appears not only be occurring in the United States, but elsewhere. But it also creates opportunities. Those types of environments create opportunities for other areas of the market that you may not have thought about and looked into. So we continue to diversify our client portfolios in other areas of the market, in other areas of the world, and in other geographic regions, and in different market cap sectors of the equity markets around the world. So I've gone on for almost 20 minutes there. I'll pause there, and we can open the line up if you would like for questions.
Yeah, we'll do that. If you're on the phone line, you can star 6, and that should unmute yourself, and you can ask a question, and I will check to see if we have any questions chatted in. I don't see anything yet. I will put you on the spot a little bit, Greg.
Sure.
No canned questions here, so we didn't rehearse this to those that are listening, but, common question that's come in is, and maybe you can elaborate because you're deeply entrenched in our investment selection process. You're one of the main committee members. What conversations are you guys having in your weekly meetings today that's talking a little bit about, what we might be doing in the next 2 to 3 months in security selection and why?
Sure. I think I've always used the 2008, 2009 time period for a demonstration of how you should look at the markets and going forward and trying not to time the markets, but because it was something that was very fresh in many investors' minds. I think we can also use this past spring as an example as well, and since it happened so quickly, the pain was even the lasting pain was even worse if you did panic and get out of the markets because of how quick the markets rebounded. And so what I would say is the questions, many of the questions that I'm getting are centered around, I've got some excess cash. I don't want to buy at market peaks, and the market has demonstrated many market peaks going back in time, and we don't know if we're at the top of the market today. I mean, we're at the top of the market, but we don't know if we're at a peak to where we're due for a sell-off. But even if we are due for a sell-off, the way we look at the market and the way we invest is we allocate capital to the stock market based on when that capital is we have a reliable understanding as to when that money will be used. And so, for instance, if you have a cash flow that's greater than 5 years, 7 years into the future, I feel extremely comfortable of investing those dollars into the stock market today because I feel comfortable that the markets are going to be higher in 5 to 7 years than they will be than they are today. That doesn't mean that we're not going to see some sort of a negative decline in the next year or two or whatever, but I don't know when that's going to occur, and no one can reliably predict when that's going to occur. So we don't try to time the market, and the conversations I'm having with my clients are, if you've got excess cash that is earmarked for a need that is well into the future, then you need to expose that to the market risk and allow time to take to do its magic on the market. And for cash flows that you have earmarked that are shorter term and say under 5 years, then you should be buying high quality bonds that will remain keep stability in that level of in those distributions, and make sure that those monies are there when you actually need them.
Okay. I haven't seen any questions come in via chat. Anyone, another chance for you on the phone line to ask any questions? I'll ask the other question that everyone wants to know: when's Apple going to hit $3 trillion?
well, simple math says when it hits 750. I guess the split, once the split goes through.
Okay.
But time-wise, gosh, I mean, it's hard to believe that a company that some astute investors will say, you know, they make smartphones and they have an online platform, continues to be as innovative as they are, and it's truly amazing, and it's another reason why you want to have a diversified portfolio that includes, you know, stocks like Apple. And when you see sell-offs, for instance, back in March and April, those are opportunities, if you don't own those types of names, to have taken advantage and added to some of those high-quality names that have very reliable cash flows. They're very high-quality companies, and they're very high quality in terms of what they do for their customers as well as what they do for society in general. So.
Yep. Well, I'm not seeing any other questions come in. So just a reminder to everyone, you can email us, pull it up here, SYB questions at syb.com. You can always submit follow-up if something pops up from after today's call and you want to ask someone. That'll come through and we'll answer those questions. If you want to propose something for us to talk about, love to hear any comments through that. So questions at syb.com. Otherwise, be on the lookout. We'll have another invite that goes out probably mid-September-ish, and we'll have another WebEx to talk about whatever's relevant in September. And then the October and November WebEx series will get nice and juicy as we have the Biden-Trump, debates really getting hot and contested, and we're in those final 30 days. And then, of course, in November, we'll have to come up with something clever to kind of speak to, whether we're talking about a Biden in office or a Trump. And we may not know in November, as I guess Trump is saying the mail-in ballots will take, months and months for them to be accounted for. But again, hope everyone's doing well out there. If you've got any questions, make sure you reach out to your advisor directly if you'd like. And again, questions at syb.com is always another way to get in touch with us. And I appreciate everyone that's joined us. Hope you have a great rest of your week. If you've got grandkids going to school, your own kids going back to school, college, high school, whatever, they may already have done so. Good luck. Can't wait to get mine out of the house personally. So it's going to be great when they start school next week. So, here's to being healthy for the rest of this month, and hope September starts off fun and entertaining for everyone. So thanks again for joining us. Greg, thank you for joining in and providing your commentary, and we appreciate it. Take care.